Hello, everyone. Welcome back to another episode of Trust Issues with Capital Trust Intelligence. Today, I'm joined by Stephen Lilley. Stephen is the manager of Greencoat UK Wind, which I think a lot of you listening will probably be familiar with. Stephen, thanks very much for joining me. To get started, could you sort of give a bit of an intro to the trust, what the thinking behind it is, and sort of why you started it, basically?
Yeah, good afternoon, David. Thank you for having me on. Greencoat UK Wind, I think, is hopefully pretty straightforward in the sense that we invest in operating UK wind. We've done that for 11 years now, and we set out really addressing a sort of convergence of needs. So, from an investor perspective, this is back into 2010, 2011, as we were thinking about it, through to a final listing in 2013. Investors, off the back of the credit crunch, wanting a dividend that was a good dividend with inflation protection on it, so increasing the dividend with RPI, but also preserving capital on a real basis. So that's where, in one sense, our product came from, that it was investor focused, the dividend that we can inflate, but also preserve NAV on a real basis. And that's been sort of a key part of the product over the last 11 years. Come back to that in a minute. At the same time, what we were trying to do was address a market need. So back in the beginning bit of the last decade, the real need for build out, where a market was probably £20 billion of operating UK wind at that point, and a real need for a secondary market, a way of recycling capital, so new build capital could be available by having a secondary market, effectively recycling that capital. So we were necessary for industry for that build out. And then I guess for society to have capital come into this sector and a way of getting towards net zero. So, we think that those three converge into one effectively with UK Wind to invest what investors want, but also what industry needs, and then what society needs. So we listed in March 2013 with a view of being able to produce a dividend that was always increasing with RPI, which we've done 11 times. Apart from this year, we increased by 14% versus RPI of 5. So we more than achieved that now at 10p per share dividend. And then we've grown now at 64% versus compounded RPI 54. So that sort of product, I guess, proved over 11 years. So that's what we're trying to do: operating UK wind, creation of a secondary market, so we can help recycle capital and get the build out and go towards net zero as aims. But as an investor product post credit crunch, a dividend increasing with RPI, real NAV preservation, which we've done more than expected, if you like. In terms, very finally, I guess, David, in terms of numbers, we've now paid over £1 billion worth of dividends. We've reinvested nearly as much as that, and ultimately this business is about return. It's about dividend and reinvestment, but it's about return. And now our return net to investors is 10%, so that's nearly 6% north of the 10-year gilt.
Yeah, and you've touched on a few very interesting points there. So I'll probably go through them one by one. But to get started, I mean, I think if you look at the sector in as a whole, the kind of, at least in the publicly listed, the market cap has gone from, I think, about 20 billion to over 100 billion, I think, in the last decade. You've grown, I think, more than tenfold. I think you started about 250 million. You can correct me if I'm wrong. To now over 3 billion. And I think when you look at that, it's very easy sort of psychologically to look at numbers like that and think actually there might not be more room to grow. Um, you've touched on the total return component. Obviously, the dividend is very important, but the way you've been able to grow is really by reinvesting surplus cash. Um, how much more opportunity do you see to do that at the moment? Is there still a lot of room for growth? As you said, we sort of head towards net zero, and there's just more and more drive towards investment in renewables.
There was a number of things there, I guess. When we started 11 years ago, the market was 20 billion. It's now 100, so it's 5 times bigger. I think we've grown by 12 or 13 times, or 15 maybe, above 10. The market's grown by 5. But then if you look at not just the Labour Party's targets, but also Conservative targets, that market's likely to, over the next 7 or 8 years, double again. And that's really a lot of offshore build, probably dependent a bit on transmission. But if we stayed at the 7% of the operating UK wind market, um, uh, we would probably be up about 60 in the FTSE at that point. If we stayed at that, and if our modelling works, there's lots of ifs there. But the market for us to grow into is enormous, and the opportunity we have to be able to be, partner of choice to all the major utilities. I think we are at the moment, but we can sort of maintain that. We are expecting that most of the transactions that, if we do them, will be um, bilateral. We can bring large pools of capital because of the size of the balance sheet already, but also within the sort of Schroders Greencoat empire, the manager, we can bring lots of co-investment capital, which we've done on a number of projects so far. And with London Array last year, we did 717 million pounds worth of investment, combination of private and the PLC, and that was bilateral, so pretty straightforward. I think you've got the size of the market, you've got the size of the balance sheet. All that's predicated to some extent is the return being high enough, and us being able to issue equity rather in due course. I think that we've done that for most of our time. The last year we have been trading at a discount, and therefore we can't do it. So we're treading water to some extent, which is a bit frustrating because the market is there for asset acquisition. But so that's why at the moment we've been talking. Capital allocation is pretty important. We think that share buybacks and probable disposals and debt repayment and sufficient return, and those are important conversations. And we certainly feel that our discount rates and return to investors are sufficiently high for a business with such low volatility, if you like. That we should be trading in premium already, but we can't issue equity rather at the moment. So we'll tread water until we can. But we're not overly concerned about where we're trading. I think the market is showing that our discount to our NAV is substantially tighter than all of our peers. I think that's really reflective of the return on equity. But at some point, especially, I think when we get interest rates moving, I suspect we'll be in a much better position to be able to be back to a premium. Albeit at the moment, I think that our return is sufficiently high that we should be already. But that's probably more about market than it is about return.
Yeah, no, definitely. And sort of as a follow-on to that, I think UK Wind put out almost, it was a bit less than 12 months ago now, but you put out a very sort of clear breakdown of your thinking about sort of dividend coverage, pricing, and that sort of, and I would recommend, if you are listening to this, we actually covered and list the entire table our in a few of our research notes on UK Wind, and then it sort of breaks down power prices, discount rate, dividend coverage, and returns, and so on. Um, have you sort of seen that played out in how you expected? I think that the real argument you were making there was basically the dividend coverage for UK Wind was very strong, and actually probably stronger than a lot of peers who are basically passing everything through. Uh, and even if there was a fairly substantial drop in power prices, that would still be the case. Um, is that so? Is that sort of played out as you thought? And where do you see things going moving forward? If you at least in the short term, I appreciate, probably long term it's harder to say.
Yeah, no, it's interesting. The long term is interesting because we set up the business on a dividend cover of about 1.7, and that 1.7 was really meant to cope with low volume. The standard deviation for production is about 10%, plus or minus 10% per year, so it's not particularly volatile. But to cope with that, but also to cope with low power prices. It happens occasionally, not long term isn't the expectation, but in the short term can be. And therefore, we set up with a 1.7 dividend cover to cope with that. Actually, since listing, dividend cover on average has been over 2 times, and thus you can sort of tell about £1 billion of dividend and about £1 billion of reinvestment. Obviously, given dividend cover being 2 times. So I think that we have set ourselves up for that. I mean, really, I guess one of the points behind that is that if you have a low volatility production, effectively, you've got half of your revenue stream being an RPI linked certificate. You haven't got a lot of debt on the business. You can then take quite an exposure to the power price. And I think what we see is, we are asymmetric on the upside, if you like. So we can't go. I think what those charts that you described, David, were mostly sort of showing that at £10 a megawatt hour, which is inconceivably low over any period of time, effectively, because gas would stop burning because you wouldn't even pay for the carbon, let alone for the gas, let alone a return on investment. So it couldn't really happen. That we'd still have an RPI linked dividend for 5 years. So I think that that's really, really powerful in that sense. But then by the structure of our business, we maintain that exposure to the upside that showed back in 22, 23, great ability to benefit from high power pricing. So we see that very much as infrastructure investors, we're downside covered. That's the first place we'd think. But actually, by doing that, then we structure ourselves so we're exposed on the upside. So we generally don't hedge power fully. We want to take the power price upside. It's not that we're not hedged. I mean, we have about half of our revenue on an NPV basis comes from the certificates and the fixed bit, if you like, and half from the merchant. And I think in 24 we've got something like 60% fixed and 40% merchant. So we're not hedged, if you like, but we do want that exposure on the upside.
Yeah, yeah, definitely. Okay, so one of the things that's sort of been current running through probably our discussion so far is the fact that rates have gone up. I think that's going to be news to anyone over the past couple of years. Um, uh, how has that sort of changed the reinvestment dynamic? I mean, you obviously said you still see opportunities. I think again, compared to peers, you're definitely not as leveraged as some. Um, but in fact, you're actually pretty lowly leveraged, I would say, compared to most. Um, but has that sort of changed the return potential? I mean, has it had sort of made you, I don't know, do you have to be a bit more selective in how you think about things, or how,
Well, precisely. I mean, I think that the other option with any um, spare cash flow, if you like, is what we got. We can pay down debt. What that just reduces about a 5% cost. Um, we could invest in assets, and that's sort of 9-10% cost, even if we're doing it now, which we wouldn't do. Or we could go and buy back shares, which obviously is significantly better than that. And so I think at the moment, we announced about October last year a £100 million buyback program, which is about halfway through. Um, that's sort of helpful. I think the aim is not necessarily to do too much to the share prices, to try and get value for investors, which is a sensible thing. If we had any spare cash, if you like, significant amount, we could easily go and do lots of transactions that were probably more NAV accretive than the discount of our share price. So I had a higher discount. So those are that would be a sort of nice thing. But as we're at 38% gearing at the moment, we're a bit away from that. So unless we do a disposal, we couldn't really do that. Are there projects that we would readily available? Yes, because actually we're going from if we're going from 100 billion to 200 billion pound market, there are definitely projects around, and there'll be lots of them over the next few years. So that's our frustration, if you like, because we can see those projects it readily in the market, but we can't do anything with them at the moment. And it's fine, we will continue to generate cash and continue to buy back shares pay down debt and all the things that we can do, and we'll, as long as we're priced properly and our rate of return is right, which we believe it is, um, the time will come and we'll be able to do that. I was just noting actually with Matt this morning. It was we were looking at general gearing across the sector, and yes, we were at the bottom of it. I think that what was the interesting point though was that um, if you uh, if you in our minds make adjustments to NAVs of people because we think rates of returns are probably discount rates need to go up effectively. If you did do that, what it does is it effectively it decreases GAV, decreases NAV, and therefore gearing is even higher than is seen in the sector because the NAVs are overstated, if you like. So I think we feel pretty comfortable that our cost of debt is significantly below our cost of equity and our return, and therefore um, we feel comfortable running at 38%, but it's frustrating because there's lots of options that we can't take at the moment. But it won't always be the case.
Yeah, yeah, definitely. Um, okay, to move on to a slightly different topic. I mean, you touched earlier in one of your answers about sort of political environment, for lack of a better term. UK Wind obviously only invests in the UK. We have an election coming up in a month's time. Obviously, predicting policies and all those sorts of things is difficult. But I think, as a general rule, that people seem to have a perception that, say, Conservative Party is probably going to be more pro hydrocarbons relative to a left wing one. But actually, if you look at the past 13 years since you've started, I mean, your growth has been entirely aligned with the Conservative government being in power. And it just seems like if you look across most of the world, actually, uh, there's this drive towards net zero that seems fairly bipartisan. Whether you're the say Chinese Communist Party or even in the US, it just seems like this is something most governments want, regardless of which side of the political divide they fall on. Is that something you see in the UK? I mean, do you have any kind of if Labour were to win, would that be more beneficial? Or do you think it's just sort of a thing that's not really it's sort of a bipartisan issue at this point?
I think it's not bad. I think you're right. It is everyone's on the same page now. I mean, it certainly was helpful in our when we listed in 2013. We obviously were trying to create something new, trying to create a new sector. We had government putting £50 million into our float. The person that signed that off was Vince Cable, um, uh, and that was helpful because effectively it was a catalyst. It meant that it was before the so-called Green Investment Bank. So he came in and did that investment. They then sold the stake and made some profit a couple of years later, and created a sector. So it was a very sensible use of money. But actually, we always felt that when we got into rather unexpectedly, I guess, the 2015 election and Conservatives won by themselves, that what would be the issue there? And there was a little bit of sort of NIMBYism, if you like, and there was a bit of inverted commas green crap, if you remember David Cameron making that statement. And actually, it was more politics than it was actually reality. Very quickly afterwards, we got into contract for differences and new nuclear and all of the worry, I guess, about how did were the ROC certificates, the renewable obligation certificates, sensible, and what was the political risk, all disappeared. So it was true in 2013 at our listing. Very quickly afterwards, just no issue whatsoever. And I think that we've seen Conservative politics become much more closely aligned with where Labour already were, if you like. So I think for us, as we go into the next election, we are familiar with most parts of the political spectrum. If you looked at, I think it's not been published quite yet, but there's a photograph in Schroders Greencoat's ESG report, which might be on the website. I signed it off a couple of days ago, which has a picture of Keir Starmer listening to an answer to a question that I was giving on Bishopthorpe. Actually, he was listening. He's quite a nice man. And so we have engaged more generally across the whole political spectrum, including Jonathan Reynolds at Shadow Business for Labour, all very sensible. And so we don't think there's any political change that comes, whatever the colour of the party coming in.
Great. Well, that's a good point, or a hopeful point on which to finish. So, Stephen, thanks very much for joining me, and hopefully we can chat again at some point in the future.
Good. Thank you, David. Thanks for your time.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.